So it's 2026. We're, what, 6 days in? And if you're watching the digital asset space, it doesn't feel like a slow start to the year at all. It feels more like a starting gun has gone off for, I don't know, a huge structural shift. The market isn't just moving. It's practically screaming at us. There are 5 loud, interconnected signals all hitting at once.
It's a moment of maximum information density. I
Yeah.
mean, you've got price action that's validating institutional interest. And at the exact same time, you have the foundational plumbing, the infrastructure, making adoption faster and cheaper. It's a perfect storm of, just pure noise and real undeniable opportunity. The challenge right now is turning all that noise into intelligence.
Exactly. And relying on gut feelings right now is, well, it's just a recipe for guesswork. So let's just list them out for everyone listening. These 5 key inputs. First, Bitcoin is holding strong, near $94,000. Second, the large cap alts are finally waking up. XRP, Solana, they're demanding attention. Third, and this is a big one, Visa has flipped real USDC settlement live on Solana for US banks. That's a massive plumbing change. Fourth, huge ETF flows are back. We're talking over $1 billion in just 2 days. And fifth, the macro backdrop is, as our sources put it, anything but normal.
Right. And our job today is not to chase every single one of those headlines. The mission for this deep dive is to show you how to filter this data using the Hive Block Strategy framework. That means placing every asset, every shift into one of 5 core categories: seed, core, flow, innovation, or yield block. And then checking its place on the Hive risk ladder, and most importantly, deciding what you do before the profit hits or the correction starts.
Okay, let's unpack this. But first things first, we need a baseline. For the listener who's well-informed, but maybe new to this specific framework, hearing 5 proprietary category names right out of the gate can be a bit much. Before we jump into the numbers, can we get a quick functional definition? What exactly is the job of each of these 5 blocks?
That's a critical point. The blocks force you to define an asset's purpose before you even invest a dollar. So think of it this way. Seed block. This is your bedrock. It's all about security custody, cold storage, multi-sig, seed phrase hygiene. If your seed fails, nothing else matters. Then there's core block. This is your long-term conviction, 3 to 10 years out. Usually low rotation assets like Bitcoin. This is the bulk of your strategy. FLOW block is your working capital. Assets for active transaction needs, often stablecoins like USDC. It's where your money is doing a job right now. Then, innovation block. This is for the experiments, high upside, high risk assets. This is where you test a thesis, knowing you can lose it all. And finally, yield block. This is purely for income generation. Staking, lending, DeFi. The goal is cash flow, but you have to be honest about the risk.
That clarity is so important. Core is the anchor, innovation is the experiment, and FLOW is the highway. Okay, here's where it gets really interesting. Let's start right at the foundation. The core block, Bitcoin. So Bitcoin's trading around, what, $94,000 US. It's gained about 6% in the first 6 days of the year, and it's consolidating firmly between 80 and 95,000. This isn't just a reaction to some good news, is it? This feels like validation of sustained, high-level institutional money.
The data supports that entirely, yeah. We map this move directly into the core block, and specifically the yellow zone of the Hive risk ladder. The sources are showing U.S. spot Bitcoin ETFs just had their largest one-day net inflow in 3 months. That's a staggering $697 million on January 5th alone, which brought the 2-day total above $1.1 billion. I mean, that is serious capital coming back in, and it validates that institutional comfort level at these prices.
It sounds incredibly bullish. The floodgates are open, price is high. But the framework immediately grounds this, doesn't it? It says, hold on, this is a core block asset, and its yellow zone rating means battle-tested but volatile. The keyword being volatile, not safe.
Precisely. The core insight for you listening is that despite all those ETF inflows, the market's temperament hasn't fundamentally changed. Not yet. A 20 to 30% correction from 94K would still be considered, normal behavior for this yellow zone asset. The institutional money might be mitigating the downside, but it hasn't eliminated that structural volatility that just comes with a global 204/7 asset.
That raises a critical question, though. I mean, 1.1 billion in 2 days is massive. Is there any scenario where that sheer institutional momentum forces the framework to sort of re-rate an asset faster than usual? Is the volatility risk actually going down because the floor is higher?
The volatility might lessen over years, but we can't just assume that's happened because we hit a new high. It's too soon. The yellow zone is defined by its ability to weather these extreme events and still trend up over the long term. That 30% drawdown risk is psychological, it's financial, and it's behavioral. If your core block has grown to $200,000 and a normal correction takes you down to 150, and 150 is your predetermined stress limit, then you haven't managed the risk correctly, regardless of how much capital BlackRock is moving. The framework is designed to protect your ability to hold through that inevitable downturn.
Because euphoria is not a plan. You have to plan the exit, or the next correction will plan it for you. And that's where the four-flow routes come in.
Absolutely. When BTC hits a major profit level, maybe it's $100,000, maybe it's just a clean 2x return for you, you cannot improvise. The four-flow routes are a predetermined rule-based split of that realized gain. Let's say you take $10,000 in profit at $100K. The framework forces discipline. You split that $10,000. A set chunk, say $3,000, goes straight to liquidity. That lands in your fellow block as stablecoins or cash. It's your buffer. Another chunk, say $2,000, immediately reinvests in BTC, reinforcing your core position. A third piece, maybe $1,000, goes to new asset staging for future innovation block experiments you've been watching. And the final part, $4,000, goes to personal outcomes. That's cash out, to your real life. Pay off debt, fund a purchase, whatever.
It forces you to diversify the gain itself, so you don't just hold on and pray. That discipline is crucial for Bitcoin. But what about the other side of the portfolio? It seems like the altcoins are finally demanding some attention. That's our second big signal.
Yeah, while BTC is consolidating, the large caps are making that high velocity move. We saw XRP jump, 9 to 11% in a single day, up to around $2.3240. It was up 25 to 29% for the whole wint. Solana also climbed more than 8%, and Ethereum is holding strong above 3,200.
That kind of speed fits squarely in the innovation block and yield block, right? Mostly in the orange or red zones of the risk ladder. I have to admit, seeing something like XRP surge 30% is a classic FOMO trigger. The temptation is to think, okay, the market's validating this, so it must be safer now.
And that is the exact cognitive error the Hive ladder is built to prevent. These assets are a different species from Bitcoin and Core. It's not about price. It's about the underlying technical risk, the regulatory risk. I mean, in past cycles, we saw top 10 assets surge 40%, and investors would prematurely move them from the high-risk innovation block into their core block. Then, months later, a major exploit or regulatory action hits, and that asset drops 70% in a week.
And you essentially doubled down on a category risk thinking you were moving into safety.
Exactly. The Hive ladder insight here is crucial. A 30% rally does not automatically promote an orange asset to yellow just because you're excited. You need years of sustained regulatory clarity and operational uptime to earn that kind of promotion. Until then, you have to respect the risk profile.
What's also tricky here is the dual role some of these tokens play. It forces you to be super specific about why you own them. Let's take SOL, for instance. It's having a great run, partly because of the news we're about to cover.
That's a perfect illustration of the dual role challenge. The token is the same, but its job isn't. You might hold, say, 50% of your Solana position directionally. You're just chasing price action. That part is firmly an innovation block position, probably orange zone. But maybe you're staking the other 50% in DeFi to earn a yield. Well, that moves that part of your exposure into yield block. And that's likely a red zone position, depending on the protocol's lockup and smart contract risk.
So the coin is the same, but the job you gave it, chase price versus produce income, and therefore the risk you're willing to take, changes completely. You're holding two different exposures under one ticker.
Right. And if you don't use that Hive question set, why innovation yield? Which corner? What are my flow routes for profit? Then the term alt season is really just a polite way of saying, I have no plan. You're just relying on hope, not strategy.
Okay, moving away from the price tickers for a minute to our third signal. The real structural headline here seems to be this plumbing schist, a huge upgrade that makes the entire FLO block 24/7. This is the Visa story.
This is maybe the most important foundational development of early 2026, because it's not about speculation, it's about utility. Visa launched USDC settlement in the US, letting major banks like Cross River and Lead Bank settle directly using Circle's USDC over the Solana network. We're talking about maybe $3.5 billion in annualized volume to start, with a broader rollout planned all year.
That is massive validation for stablecoins as a utility. So how do we map this in the Hive framework?
This is a crucial FLO block story. The asset itself, USDC, is generally a green or yellow asset, depending on how you hold it. It's the bridge, the buffer. But the infrastructure, Visa, and regulated banks moving this on the Solana protocol, that adds a critical layer of yellow/orange risk. You have to separate the asset risk from the protocol risk. USDC is stable, but Solana still has smart contract and uptime risk. So the whole setup is yellow-orange.
And the key change for the listener isn't just Visa is using crypto. It's getting rid of those bank hour settlement delays that have plagued commerce forever. So no more waiting for Monday morning for a wire transfer.
Exactly. The big takeaway is that FLO block is becoming 24/3. Money can move on nights, weekends, holidays without waiting for a bank to open, without stacking all those intermediary fees. It dramatically improves transparency and predictability for businesses.
And beyond just speed, the source material really highlighted the huge implications of programmability. That's a pretty abstract term. How does that actually work for a business?
Programmability is the game changer. It's the ability to embed payment logic rules directly into software. So imagine you run a digital content platform. Before, when a sale happened, the money sat in escrow for days waiting for the bank. Then you had to manually split it between 5 different creators in 3 different countries.
With multiple foreign exchange fees along the way, I'm sure.
Precisely. With a programmable stablecoin, the moment the revenue comes in, a smart contract can instantly verify it and split the proceeds. Creator A gets 40%, Creator B gets 15%, the platform takes its cut, and it all settles in a minute. It eliminates escrow time, it reduces manual work, it cuts fees. The question the PodVibe analysis posed is simple but profound.
Yeah.
If your money could settle in minutes, what would you automate first? That question forces you to audit the efficiency of your own FLW block.
That's a powerful shift. Okay, let's circle back to institutional capital for our fourth signal, but this time through the traditional rails, ETFs and crypto infra stocks.
Yeah, we really can't overstate the scale of this demand. Like we said, 1.2 billion flowed in during the first 2 trading days of 2026, mostly to BlackRock's IBIT and Fidelity's FBTC. Even the ETH spot ETFs saw over 170 million in net inflows. The traditional finance world is actively plugging this exposure in for their clients.
And at the same time, all the listed crypto infra companies, miners, exchanges, AI, crypto hybrids, they're rallying hard because the market is pricing in better revenues with Bitcoin over 90K. It seems like a simple, easy access win-win scenario.
It is a win, but the Hive Block Strategy treats these with a crucial bit of nuance. They are expressions of core or innovation or yield, but they are not core block itself. This introduces what we call wrapper risk.
Wait, if the ETF tracks Bitcoin perfectly, why treat it differently from a core perspective? Isn't the underlying exposure basically the same?
The price exposure is similar, yes, but the risk profile is compounded. The ETF wrapper adds fee layers, it adds counterparty risk, is the custodian trustworthy, and it adds all the regulatory layers of the traditional stock market. You're basically exchanging the complexity of self-custody for the complexity of regulatory and corporate risk. Same for minor stocks. They might track BTC price, but they add equity market risk, management risk, business model risk, things a self-custodied coin just doesn't have.
So even though they represent the digital asset market, you have to assess them based on the risk of the wrapper they come in.
Absolutely. The 2 critical mapping questions for you, the listener, are, first, do these things live inside your Hive strategy, assigned to blocks and zones, or in a separate traditional stock sleeve you track on its own? And second, if they are inside the Hive, how did the flow rates apply to them?
Meaning a profit you take in IBIT or FBTC should still be managed by the same 4 rules as a profit you take on your own.
Exactly. Even if the asset never leaves your brokerage account, that profit can still be functionally split into liquidity, more BTC exposure, a new asset test, and personal abstraction. The Hive doesn't care where the asset is located. It cares that you are honest about its job and how you plan to manage the gains with rules, not emotion.
So what does this all mean? We've looked at 5 massive signals. High prices, altcoin surges, an infrastructure revolution, huge institutional inflows. The market is noisy, we've got thin liquidity, derivatives are rebuilding, macro risks are still out there. It's an environment that seems built for maximum FOMO and fatigue.
It is exactly the kind of volatile market this strategy was built for. And the 5th story, the real pattern under all these headlines, is the importance of the boring parts. When the market is shouting at $94,000, it's dangerously easy to forget about seed block.
The foundation. The custody, the cold storage, the multi-sig, the seed phrase hygiene. The stuff that keeps your assets safe whether BTC is at 94,000 or 40,000. That's the starting point.
That's the core. Then you have core block, what you hold for 3 to 10 years. Flow block, the money doing active jobs. Innovation, the high upside experiments. And yield, the income generation. Relying on this operating system is the critical difference between a moment being interesting and being catastrophically expensive.
So the structural starting point for 2026 isn't predicting where Bitcoin will end the year. It's about taking action on the strategy right now.
Start by writing down 3 honest sentences. First, why you use crypto at all, your foundational why. Second, which corner you are operating in this year, build, optimize, or harvest. And third, what level of drawdown would truly start to affect your real life, your predetermined stress limit?
And just to quickly define those corners for everyone, build means you're maximizing accumulation and you're okay with high risk. Optimize means you're balancing growth with income. And harvest means you're focused on extraction and minimizing your principal risk.
When those 3 answers are honest, news like Bitcoin near 94K and Visa launches USDC settlement on Solana stops being a series of emergencies. It becomes a controllable input for your strategy. It has to earn its place in exactly one block in one zone with one set of flow rules, or it stays on the watch list.
And when those parameters are locked in, you shift your entire mindset from reacting to headlines to actually utilizing them. You now have the roadmap to start defining your own Hive structure for the volatility and technological upheaval ahead.